Target just announced something so unthinkable, your world's about to flip. I'm Steve Van Metre, your host, and welcome aboard. In just days, something wild and something terrifying is barreling toward us. Worse, it's not just Target. As you're about to see, it's every major retailer, and the economic fallout's going to be a complete nightmare. Stick with me because this is unfolding right now, and what's coming will leave you completely speechless. Plus, we have a sponsor for today's show. I'd like to welcome Wearable Devices. You can find them on the NASDAQ symbol WLDS, and they pioneer a non-invasive neural interface, turning subtle finger movements into seamless digital control. They're in the final stretch of manufacturing the Metre band, an aftermarket Apple Watch band that brings touchless magic to your wrist. Stay tuned to the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked today's story with a headline as Target announces the unthinkable as they and Best Buy warn U.S. consumers of higher prices from tariffs. And this is coming and very soon to shelves near you from companies all over the country. You're going to watch them raise their prices and say, look, we have no choice. Prices are going up due to the tariffs. But the reality is the inventory on their shelves is not affected by the tariffs, but they're going to use that as an excuse to raise their prices and increase their margins. Target Chief Executive Brian Cornell says shoppers would likely see price hikes in his stores over the next couple days, noting that they see a significant amount of goods and fruits coming from Mexico during the winter. He said, we're going to try to make sure we can do everything we can to protect pricing. But if there's a 25% tariff, those prices will go up, and that's going to impact every major household across the country, whether you shop at Target or not, because you're going to see retailers raising their prices across the board. And one of the issues we're facing is the U.S. economy is slowing. We're already seeing income growth slow down and hours worked are getting cut. This is making it even worse for American households that are struggling to keep up with inflation. And what this is indicating is the demand is going to plunge in a major way. Shares in Target, speaking of plunging, which says now projecting little to no sales growth this year, we're down 4% in pre-market trading. Keep in mind, they're going to be lucky to see little or no sales growth this year. If demand continues to fall, they're going to see negative growth. We're going to see that across retailers all over the country. And the issue is when demand goes down, well, there's another part of the demand equation that falls, and that's the labor market. And let's take a look at what's coming for companies like Target. As we look at the consumer price index in blue against real retail sales in red, both shown on a year-over-year rate of change. And when you see periods where there's rising inflation and slowing income growth, just like what happened back in 2000, well, retailers see a decline in demand and ultimately a contraction when we head into a recession. You can see that happen once again going into the global financial crisis. The consumer price index was surging higher due to rising energy costs. Income growth did not keep pace, and it had an immediate impact on retail sales. It slowed down to the zero bar and then entered a contraction. Now, where are we at? Well, we see inflation likely to go higher, not just from the standpoint that manufacturers and service providers said they're going to raise their prices, but tariffs are now in play. We've already seen 3 years of largely negative real retail sales. Target says it's going to be a flat line next year. In reality, it's going to be negative. They're going to see demand outright plunge in a major way. And again, this is something that American households are not going to be able to escape, because if prices go up and wages are not rising in kind, well, what it means is there's going to be a major cut in spending. It's going to happen on the discretionary side, my friends, and it's going to backfeed through the rest of the economy. But as we started the show, it's not just Target. Best Buy also echoed price warnings on its own earnings call, telling investors that price increases are highly likely on the gadgets and appliances it sells due to tariffs. It notes that China and Mexico are its top two sources of products for the company, and here we see it again. Prices are going to go up. Demand is going to come plunging down, because look what happens to the manufacturing sector as we now look at durable goods and new orders. That's shown in red on a year-over-year rate of change against the consumer price index. Again, we go back leading into the dot-com bubble. What do we see? Prices rising, income growth slowing, and look what happens to new orders. It's just like retail sales. As retail sales declines, well, demand for new products goes down, and you see new orders decelerate and then enter a massive contraction. Let's move forward going into the global financial crisis. Once again, prices surging, incomes not keeping pace, retail demand plunges, new orders, massive contraction. And this has a huge impact on the economy, because if manufacturers aren't producing goods, well, they don't need workers. They have huge cuts to their workforce, and this is going to be coming. We'll talk more about that in a bit. And let's look at where we're at now. Inflation looking to surge higher. And now, based on what we're hearing from Best Buy and Target, we can expect durable goods new orders to plunge. And that's, again, going to impact manufacturing jobs all over this country and in a huge way. The American people are counting on President Trump to bring down costs and grow the U.S. economy. Tariffs on Canada and Mexico put those goals in serious jeopardy and risk destabilizing the North American economy. Well, there's a challenge here because if you're trying to get rid of inflation, one, you could raise supply in the economy by opening the borders and allowing a flood of goods to come in. The problem is the sacrifice would be a domestic American jobs. The alternatives, you could put walls of tariffs up and then force those jobs to stay. But the reality is there's going to be an immediate impact in the economy. We're going to start seeing it this week as retailers raise their prices. How consumers will respond? Well, I think they're going to say no and reject those higher prices. If you agree with me, hit that thumbs up button in the bottom right of the video. But wait in the comments, I want to know how you think the tariffs are going to impact the American consumer, how you're going to respond with your spending. Other economic red flags include expectations that U.S. inflation will remain high and the sharpest decline in consumer confidence since 2021. And that is a problem because high grocery prices are squeezing lower income consumers. Now, I'm going to show you here in a moment the impact of high prices and slow income growth on consumer confidence. It's going to blow you away about what's coming here in the near-term future. Target said February sales were soft as cold weather affected apparel sales and declining consumer sentiment affected non-essential categories. And that makes perfect sense because when people lose their confidence about the economy, what they're really telling these surveys is they're losing confidence about their labor market. They're concerned that their hours are going to get cut and perhaps their job is going to get cut. And the big issue is there's no opportunity or very little opportunity in the workforce to find another job. When that happens, well, you cut your spending in a big way. The company expects those trends to moderate. They'll remain appropriately cautious through the year. Well, things are going to get worse for Target and a lot of other retailers, not to mention American households. Let's take a look at the consumer price index, still shown in blue, against the unemployment rate in red, overlaid with the University of Michigan Consumer Sentiment Survey, that in green. And we can go back here to this period where I've got circled, and what you see is inflation rising and the unemployment rate rising. And then what happens? Consumer confidence comes plunging down. Now, it makes perfect sense because that decline in confidence causes retail sales to plunge. And as retail sales come down, new orders come down, and the economy unwinds, and you see the unemployment rate head even higher. Now, let's move forward to the dot-com bubble. What do we see? Rising inflation, rising unemployment, massive plunge in confidence, right into a recession. Let's take a look at the global financial crisis. What do we see? The same recipe. Inflation heads up, then it hits the labor market, and next thing you know, confidence comes plunging straight down. And look where we're at now. You've seen confidence rise as people were optimistic. They thought the economy was going to turn around. What we're facing is rising inflation, a high probability that the unemployment rate is going to head higher, and that means consumer confidence likely to plunge once again, setting us up for what could be the next big recession. But let's take a look because Trump now is escalating the global trade war, sparking a tit-for-tat tariff. So let's look at what's driving the markets down today and all of the panic from Target and Best Buy. The new U.S. tariffs, 25% duties on most Canadian and Mexican imports, and raising the charge on China to 20%, apply to roughly $1.5 trillion in annual imports, an expansive move signaling to markets that the Republican president is committed to inflicting economic pain to generate fresh revenue and create domestic manufacturing jobs. Now, this is very interesting when you compare this to Trump's first term, where his focus completely on driving the stock market up. What we're seeing now is the stock market have a massive negative reaction to the tariffs. But as you look deeper into what's going on here, this is all about the strength of the U.S. economy, because in the end of the day, the world does need to trade. There are things that we need and other countries need that we have. The reality is, whose economy can withstand this the longest? Because if other economies are weaker, and the evidence suggests that's true, and they break, that means they're likely to negotiate very favorable terms. The question is, will it happen before everything falls apart? You weigh in the comments. Love to know. Because Canada hit back with phased levies on $107 billion worth of U.S. goods, while China imposed tariffs as high as 15%, mainly on American agricultural shipments, which is odd because we know that China desperately needs food sources. The Mexican president said her government would announce tariffs and other measures on Sunday in response to Trump's new charge charges. She said she was likely to speak to Trump on Thursday, and no doubt one of her goals is going to be to make a deal with Trump, get these tariffs off the books, and create some sort of mutual benefit trade for both countries. And over the medium term, which is what we're focused on, it's a focus on Main Street. Wall Street's done great. Wall Street can continue to do fine, but we have to focus on small business and consumers. And there is some truth to that from Treasury Secretary Bessent, because if you look at small businesses, they were meant to be major beneficiaries of the Trump economy in his second term. But what happened? The stock prices jumped, and then they came down because what did small businesses say? Despite the fact that their optimism was surging, the amount of foot traffic and spending in their stores and businesses did not increase. And so right now, what we're facing is small businesses for the last 3 years have been struggling to get by and hoping for a change. And now the problem is they need something, and they need it in a big way. Perhaps the tariffs are the answer, drive domestic consumption. You can see the focus now, again, not completely on the equity market, but on the domestic economy. Is the U.S. resilient enough to survive this and come out shining? Well, we'll find out soon enough, because the tariffs bring American import levies to their highest average level since 1943. And right now it's projected it would lead to as much as $2,000 in additional costs for U.S. households. So keep in mind, low-income households are well behind inflation. They are financially struggling in a major way. And what do we see? Middle American households, they're struggling. What is this going to mean? Less discretionary spending. It's going to hit, and hit very hard and very quick. The only reaction then is how fast does a labor market unwind and the Fed react? The lesson of the first few weeks of Trump's presidency is that these things can change depending on the concessions countries are willing to make. But if they endure, the impact will be significant. And my bet is that Trump believes that these countries will make major concessions and very quickly, because their economies are far weaker than ours. And this hit could cause a massive unwind in their labor markets, putting pressure on the governments to make a deal. We'll find out very soon, because Trump has also said a 25% tariff is in the works for the European Union, which I believe could totally send them plunging into recession, and is investigating levies on copper and lumber imports. Steel and aluminum tariffs are also set to take effect on March 12th, further impacting Canada and Mexico. But let's talk about the impact this is going to have on the U.S. manufacturing sector, particularly labor, because what we've seen since the election is a bit of a renaissance in the manufacturing sector, but we said it's not going to live very long, and sure enough, the evidence is mounting. As we first turn to the S&P Global, who notes that the U.S. manufacturing sector growth accelerated noticeably in February, giving many people a lot of optimism that the U.S. economy was going to turn around. But there was also evidence that some suppliers were already adjusting their prices upward in direct response to tariffs, with input cost inflation increasing to the highest level since November of 2022. So here's what we can see already. The suppliers are saying, look, we know tariffs are coming, so we're going to buy and manufacture as much goods as we can here at these lower prices, and then we're going to push it out the door based on the incoming tariff prices, and consumers are going to have to absorb that whether they like it or not. The problem is consumers aren't going to like it, and they're simply going to reject them. New work rose to the greatest degree in a year, with firms pointing to stronger market demand for their goods in February. Growth was partially driven by client restocking, with customers reportedly keen to get ahead of higher prices and possible supply challenges should a wider range of goods be subject to tariffs. And it makes perfect sense. If you have a business that carries inventory, you want to buy ahead of the tariffs. In fact, you want to buy as much as you can, because when those tariffs come into play, you can simply raise your prices and sell those goods at a much higher margin. The problem is they're unlikely to move off the shelves very quickly. And the clearance of work outstanding also got worse, as the latest data showed that backlogs declined for a 29th successive month, and to a slightly faster degree than at the start of the year. So if you look at manufacturing workers, here's what they're facing. As new orders are going to drop off after the tariffs hit, they're also facing the fact that backlogs are getting exhausted and very quickly. What this means is they're going to see their hours worked get cut. That will be the best case, but unfortunately many of them are going to find their way right to the unemployment line as companies look to cut costs and heads in a big way. Job creation was also linked to positive projections for growth in the year ahead, and you can toss that right out the window. The stock market right now telling us growth and inflation expectations coming down. We're also seeing that in the bond market. The reality is these tariffs are going to hit hard, and what many people didn't expect is they're going to find out in this coming week just how bad it's going to be. Now let's turn to the ISM Global, where you get another picture of the U.S. economy. And what do we see? Unlike the S&P Global, new orders enter a contraction. Employment also contracting. How about this? Prices paid jumped, and that means prices coming out the door likely also heading higher, and backlogs of orders also contracted. And the data is very clear, my friends, as it suggests not only the U.S. economy, but the global economy is headed straight into a stagflationary recession. The only question remains is how fast will these other countries come to the negotiating table and make concessions to bring these tariffs down and save their economy along with the global economy. But there's one thing we are bullish about, and that is the stock for our sponsor for today's show, Wearable Devices. You can find them on the NASDAQ under symbol WLDS. Everything you need to know in the pinned comment and description below, because they develop non-invasive neural input interface for controlling digital devices using subtle finger movements. And they're in the final stretch of manufacturing their Metre band, their first B2C product, an aftermarket Apple Watch band that brings touchless magic to your wrist. And Wearable Devices is transforming human-computer interaction with its AI-powered neural input technology for both consumer and business markets. Its innovative products like the Metre Band and Metre Link allow for touch-free interaction by converting subtle movements into intuitive controls while enhancing experience in gaming in AR, VR, XR. The company employs dual-channel business model offering direct-to-consumer sales and enterprise licensees while setting new input standards for the extended reality market. And they have the world's first neural wristband that's interpreting neural signals, enabling hand-free control of your Apple devices through simple hand gestures. And Wearable Devices has announced the development of large motor unit action potentials models, a groundbreaking technology aimed at revolutionizing human-computer interaction by enabling personalized, intuitive gesture control through the decoding of neural data. This innovation has the potential to enhance users' experiences with digital devices and integrated augmented reality platforms, paving the way for seamless interactions in the AI and XR era. And they've also introduced large MUAP models, a cutting-edge technology aimed at revolutionizing human-computer interaction through personalized gesture control powered by neural data. The decoding MUAPs are designed to create intuitive interactions with digital devices, positioning the company for advancements in the emerging fields of artificial intelligence and extended reality. They've also developed innovative AI-powered gesture control technology aimed at transforming user interactions by enabling personalized micro-gesture recognition through neural wristband. The company is focused on creating a seamless, intuitive experience across extended reality devices and aims to collaborate with industry innovators to enhance accessibility and engagement in AI-driven environments. And again, you can find Wearable Devices on the NASDAQ under symbol WLDS. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.